arguing that the recent 65% drop in CoreWeave, or CRWV, is a massive market overreaction, setting a bold price target above $133 based on secured revenue and current valuation compression.
Right.
What immediately struck me was just the clarity of it. The core thesis is so confident. The market is obsessing over the cost, the burn, as they call it, while completely ignoring the guaranteed revenue from that, $55.6 billion backlog.
That clarity is really the foundation here. I mean, the analysis has expertly identified the market disconnect. The conclusion that Wall Street is just wrong about this drop, it's very persuasive.
It is.
But, if we're dealing with an asymmetric trade this large, where the upside is so dramatic, persuasive isn't enough. We need to be ironclad.
Yeah, absolutely.
Our goal here is to take this from a strong buy recommendation to something that is, institutionally flawless, counter-argument proof.
Agreed. To do that, we have to hit the big picture risks head on, the things that institutional readers are really worried about. And thinking about that core panic, the first thing that jumped out to me was the lack of a real financial bridge in the analysis.
Yes. While the report establishes that high revenue floor, the analysis could be strengthened by directly confronting and quantifying the liquidity concerns driven by CapEx.
Exactly.
Right now, the material, it sort of frames the $110 million quarterly loss and the huge ramp-up in capital expenditures, the CapEx, as just a bare focus, something to be dismissed because of the big backlog.
But here's the issue with that. That CapEx, the cost of building everything, that is the single most pressing fear for skeptical institutions. I mean, the company's spending billions now to get those Blackwell clusters online. If you don't show how they navigate the funding gap between that spending and, say, net profitability by 2027, you're leaving the core reason for the Wall Street panic sell-off totally unaddressed.
It looks less like you're dismissing the bear case and more like you're just evading the liquidity question.
Yes.
Exactly. The weakness isn't that the backlog is weak. The weakness is failing to explicitly model the path to solvency. It's the difference between, stating a destination and actually providing a map to get there.
So the suggestion for improvement is to integrate a specific high-level cash flow forecast, a model that explicitly ties the CapEx stabilization timeline to the revenue schedule.
Right. This transforms it from a philosophical defense into a financially supported rebuttal. It tackles those solvency fears head-on.
And the operational rigor that adds is immense. If the target is a high-level institutional reader, you have to speak the language of liquidity. So let's think about concrete ways to do this.
Okay.
One highly effective approach is to create a specific visualization or maybe a dedicated section titled CapEx to Cash Flow Bridge.
Oh, I like that framing. The bridge.
So this model would project the funding requirements, the CapEx, through, say, late 2026.
Revenue is inevitable. It makes the current spending look necessary and manageable, not reckless.
Right.
Now, alternatively, if building a full cash flow model feels, too granular for this report, the author could introduce a powerful sensitivity analysis instead.
That's a great intermediate step. How would that look?
Well, it would show the audience precisely how much CapEx deceleration is actually needed for CoreWeave to hit its target of being EBITDA positive now and then net profitability by 2027.
Okay.
It adds serious rigor to the claim that margins will expand rapidly by pinning that optimism to a measurable target. It shows the margin compression is temporary and engineered.
And I guess a third option could speak directly to the leverage concern, right?
You could, yeah. You could explicitly quantify the company's leverage ratio and show that even with continued spending, that massive backlog makes the debt inherently manageable.
Using the backlog as collateral is totally different than just borrowing for speculative growth.
Totally different. And the choice between those three really comes down to audience. Credit analysts, use the leverage ratio. Equity investors, use the sensitivity analysis. The general skeptical market, that visual bridge is probably the winner.
Okay, moving on, let's look at the element of structural security in the report. Specifically, that $6.3 billion NVIDIA capacity agreement. It's currently framed as the NVIDIA insurance policy. And I can see why. It makes a strong case for this deal being a crucial revenue floor, that it effectively removes demand risk.
I see the value there. I really do. But I wonder if the focus on risk elimination has obscured a necessary trade-off. The analysis of that deal could be more precise about its potential impact on, say, operating margins and flexibility.
You think so?
Well, by presenting it as a flawless insurance policy, the report implies zero margin risk, along with zero demand risk.
And that's the weakness. It doesn't explore the quality of that revenue stream relative to, the primary take-or-pay contracts they have with hyperscalers like Microsoft.
Exactly. If NVIDIA is stepping in as the buyer of last resort, the backstop, it stands to reason that this capacity is potentially being bought at a lower margin.
Or under different terms.
Right. And failing to address that potential trade-off security for a lower margin, it just slightly weakens the analytical integrity. It can make the report feel a little naive about corporate negotiations.
Okay, so what's the fix?
The suggestion for improvement is pretty simple. Just acknowledge the potential margin implications of the safety net. It makes the argument more robust, more intellectually honest. You keep the bullish theses, but you show you've considered the fine print.
That's a crucial distinction. We want the report to feel authoritative, not just promotional. So for concrete examples, you don't need a whole new section for this.
No, not at all.
It's to just introduce a clarifying sentence in that NVIDIA insurance policy section. Something saying that while the deal eliminates demand risk, the revenue, if used by NVIDIA, is understood to be cost-covering or margin-supporting, not guaranteed high-margin revenue.
That's the most efficient solution. That subtle clarification instantly bolsters credibility.
Right.
Another path, though, is to use the comparison strategically. The analysis could briefly compare the strategic value of the NVIDIA deal, which is huge for supply chain access, against the opportunity cost of having $6.3 billion in capacity locked up.
I think I prefer the subtle clarification. The opportunity cost angle feels like it might distract a bit from the core argument about security.
Fair enough. Well, a third option, if the terms are confidential, is to frame the deal away from profitability altogether.
How so?
You frame it as a mechanism primarily designed to secure hardware flow and manage asset depreciation. Securing hardware in the current GPU environment is arguably a greater strategic asset than just guaranteed high margins.
That's incredibly astute. That framing alone is a powerful argument.
The author has options. They can add that nuance without killing the bullish thesis.
Absolutely. Okay, now let's transition to the structure and flow of the analysis itself. The report does such heavy lifting on the fundamentals. It builds this really sophisticated, strong buy case rooted in contract law, secured cash flow. Pointing out that a 6x sales multiple for 134% growth is irrational.
Precisely. And this is where the issue of audience alignment comes into really sharp focus. The inclusion of basic technical analysis signals, things like RSI approaching 30, or these simple $62, $64 support zones, it just disrupts the authoritative flow.
It's jarring. That's the weakness. The transition to Section 4, technical analysis, feels under-researched compared to everything else. For a high-level audience interested in corporate contracts, suddenly leaning on simple momentum signals, it just lowers the whole analytical quality.
It really does.
It's like ending a finely crafted wine pairing dinner with a packet of instant ramen.
Yeah, it's a profound mismatch in tone and depth. So the suggestion is straightforward. Either get rid of the technical analysis section entirely to keep the focus pure, or elevate it. Elevate the discussion to focus on institutional positioning, which actually aligns with the rest of the report.
Let's focus on elevating it because the technical movements are relevant to the timing of the trade, just not through simple charting.
Exactly. If the section is kept, the discussion has to move away from basic signals and focus on hard institutional data, specifically that massive 15 to 20% short interest.
Yes.
That creates a far more potent and unique argument. You analyze the implication of that short interest in the context of the $55.6 billion guaranteed backlog. This is a potential short squeeze catalyst. You're using technical data to quantify institutional risk, which suggests a violent repricing is coming.
That is the language that supports the aggressive price target. Or another strong option, you could rename the section to institutional positioning.
I love that.
And you discuss why sell-side analysts have an average target of $133 and a high target of $245.
Yes, you contrast that robust consensus with the current trading price. You're effectively using the analyst ratings as your primary technical signal of irrational levels. It frames it in terms of market expectations, not chart patterns.
And if the author is just intent on showing seller exhaustion, they don't even need a dedicated section. They could just integrate the tapering selling volume into the conclusion about fear being priced in.
It really just comes down to focus. When your fundamental argument is this powerful, you have to make sure all the supporting material reinforces that power instead of accidentally undermining it. The goal is to show why institutional money will be forced back into this stock, not just why the chart might turn around.
This has been a really deep dive into an already effective analysis. You've presented a very strong case that Wall Street is wrong about the drop in CRWV.